Welcome back, investors, to Ticker Time News. I'm Adam, and we're trying out a new live stream program today to see if the clarity is a little bit better and to see how it goes. So let me know if you like it or not, and we can go back to the old one or we can stick with this one. So we'll see how it works. Now, today's price action in the market was relatively, well, what would I say? Algorithmic in the terms of our current correlation picture that we have. Dollar down, yields down, stocks and commodities up. It's a picture we've seen, right? When it's the reverse happens to the stock market. Now, there was a pretty neat catalyst for today, and we had no idea whether that catalyst was going to be good or not, but it was based on good earnings. Retailers were a specific area of strength. Best Buy, good earnings, up 12.8% today. Abercrombie & Fitch, up 21.4%. American Eagle, up 18.2%. Burlington Stores, get those big winter coats, up 20.5%. All of those companies logged big gains today, all in the retail sector, which helped to drive the Spider S&P Retail ETF, ticker symbol XRT, not to be confused with FTX. I think those are some of the same letters. But anyways, XRT, the retail ETF, was up 2.7% today. So really nice. Now, many stocks came along for the upside ride as market participants took advantage of thinning holiday trading conditions. Oh boy, was volume down today. Look at this. It's tough to see. It's the green and red. Looks like mountain peaks down here close to the bottom. Volume yesterday was at right at 2 billion, with the average sitting right about 2.6 or 7 billion. Well, it got down to 1.9 billion today. So another 100,000, not 100,000, 100 million trades less today than yesterday, because we were sitting right at 6 billion yesterday. So that'll continue to drop off tomorrow, and Friday there will be just that, but hardly any volume at all. So traders were taking advantage of this thinning holiday trading conditions to do some tactical and maybe even some opportunistic trading. Remember yesterday, we put forth several stocks that were ready to go, right? They were flagging. They had setups that were ready. Every last one of them popped today, but I can't pat myself on the back because it was nearly an entire market popping today. Remember, we looked at ADM, we looked at Alphabet, we looked at Enphase. They were all on the upside today. Even ExxonMobil, we looked at that yesterday, saying, those stocks were setting up, they were ready to go. And of course, they did pop today, but several did. Let's see. I want to try this out. I want to see if it works. See how things go. This is a new live stream setup. So I'm just curious if this works out. I think the clarity of the chart will be better on this particular platform than the platform we've been using for the past several months. So let me know if you think so as well. And if so, we can continue using this one. Yeah, it is. This one for the screen itself that it's sharing, it is doing it 1080p. So it's full HD for screen sharing. So that should at least bring a little more clarity to the charts, which is what I would like for you guys. So when I'm pointing things out, it's not so fuzzy. It's a little easier. It's a little clearer to see, what's going on the charts. That's the big important thing to me. Now, if we go back to this, what happened today, right? Every sector was higher. energy, XLE, miners, materials. Miners are XME, materials, XLB. They led the pack. We had technology, XLK, and semiconductors, SMH. They trailed really close on the heels thanks to strength in mega cap stocks. But the moves came on the second lightest volume day since August, as desks on Wall Street begin to empty out for the holiday break. Just wait till the volume tomorrow. It's going to be even less. And remember, just because there is less volume, that does not mean that there's less volatility, okay? When there is little volume, stocks can go moving very quickly because it doesn't take that many orders, bid orders, to take things up, and it doesn't take that many sell orders to cool things off. Okay, so just keep that in mind. And also remember, at these big hedge funds, there's probably a protocol in place that says, hey, don't trade tomorrow when the big dog's out of the office. So we have to keep that in mind as well. That'll play into how tomorrow reacts. So when we get the FOMC minutes tomorrow, and if it reads like a hawkish hawk fest, I don't know what else to call it, we may not get that reaction until Monday. Okay, we can still get a reaction tomorrow, but we may not get the reaction until Monday, just because of the fact many people are out of the office for this holiday weekend coming up. Okay, or I should say extended weekend, Thursday, Friday, Saturday, Sunday. A lot of people are gone. Now, notably, healthcare, XLV, and industrials, XLI, both closed at new 7-month highs. I don't know if I still have it. Yep, market cycles right here. Remember when we were talking about this and talking about healthcare? It's let me clean some of this stuff up here on the chart. There we go. Okay, remember we were talking about towards the end of the cycle, we get into early recession. So in this block right here, we're in a bear market. So if we take that up right there, boom, healthcare pops into there, utilities are in there, real estate's in there, but this time, I know it's weird to say, this time is going to be different. Real estate may not do so well. Obviously, we know why. It ran up. Financials can do good, especially with the 10-year coming down. Financials can do good when we're at the end of the cycle. So we are at the end of this cycle. And of course, utilities, they are strong. They are defensive. Healthcare is also a defensive sector. But when you look at the big sectors, you've got consumer staples are big, energy, discretionary, technology. Those are like some of the big ones, especially technology and discretionary. They are hugely weighted in the market, and that's why when we get to the actual end here of our little bear market drop here and we start to pick up steam, that's why right there we can pick up so much steam, because technology and discretionary, which are two heavily weighted sectors in the S&P 500, can get us out of this bear market in a snap real quick. So do need to watch this chart and talk about it, and try to watch for signs for where we are. Obviously, we are, I believe, right here at the end of this thing, early recession, already into the bear market, and maybe first quarter or second quarter next year we'll get over here, full recession, market bottom, and then we can start finding our footing again and start stock picking. and picking the winners, even though nearly everything will rally out of the bottom. Okay, major resistance looms here. Let's talk about the SPX, the SPY, the Qs, the IWM. So we're prepared for tomorrow. Okay, right now for the SPX. Okay, you can see the pattern that we had here. Let me get the highlighter, and also I'm trying to pay attention to this. The chart, it shouldn't lag as much on this new system. Okay, so that's another reason why I swapped things up here for the clarity of picture on the chart, and it shouldn't lag as much. Okay, so we had this set up right here, resistance, support, symmetrical triangle. We go from last Thursday's high all the way to yesterday, and basically we went nowhere. All right, same exact, where we ended on Thursday is where we ended yesterday practically. So symmetrical triangle kind of building here, flagging pattern. You could also, and let me just put that up here real quick, because we could flag as well, which is the resistance there, and we could connect here to here, and boom, we have a flagging pattern. Up we went, and then we started to consolidate, bouncing back and forth and around, and today we finally break out of that. But if you notice the red line right here, oops, we got to put the brakes on. Why? Because that's resistance. It's going to be sticky. We closed at 4,003. Right now, 4,000 to 4,008 is the sticky, grippy resistance. Okay, and it can shut this thing down right here, right now. Maybe tomorrow's data, and I'm going to share with you what tomorrow's data is going to look like. Maybe that takes the fun out of today's rally. It's possible. Now, the upper end of the weekly expected move is at 40.37. So if we do happen to push through this sticky spot, 4,000 to 4,008, then maybe there's a chance that we end Friday up at that weekly expected move. But I do not think we're going to get any higher than this 200-day moving average and this downsloping trend line. They are going to start converging here. As the market moves up, it's going to push that 200-day up, which then could, cause it to, instead of downsloping like this, it could start to turn and flatten out and then go and meet up with that downsloping trend line that has stopped every major rally in 2022. So that is a possibility indeed for the SPX. All right, let's go look at the SPY here. Same setup, same breakout, same resistance. All right, 400 to 403, let's call it. It's going to be sticky, and it got stuck right there. 399.9 is where it closed. 400 is resistance. Same setup, symmetrical triangle or flagging pattern. You could see both there on the chart, and that works out just fine. Now, like and let me go over here real quick. I need to get the chart and bring it down a little bit. Like with the SPX, we have got the 200-day right here, and we have got the downsloping trend line, and they're going to start converging if this market does start to, go up a little bit. Maybe we get to the upper expected, the weekly expected move by Friday at 403 there. It's possible, but once we get to that 200-day, it's going to shut things down. It's going to shut things down. Now, good idea right here. Good idea. Let me put this up here. I want this market to go higher. I do. I want this market to go higher. I want it to get to that downsloping trend line, 200-day moving average for the SPX and the SPY, because I want to build into my short position. Because I do not think that this market is going to break through that resistance, because it has stopped every single rally in 2022, that downsloping trend line. So I'm there. The 200-day moving average was in confluence with that downsloping trend line during the summer rally when we got to mid-August, and we put a stop to that rally. Yeah. So if we start rallying a little bit more, that 200-day moving average and the trend line resistance will be converging there for each other. Now let's go. Let's keep moving. Let's keep moving on. Okay, let's see here. Clean this chart up real quick. So far, I'm liking this new software. The screen, the chart just seems to not lag as much. Okay, so 400, we've got resistance there. If the data tomorrow is decent, if the Fed minutes aren't too hawkish, then we could continue rallying and go that way. But if we do, and we start to get up there towards the trend line resistance, maybe early next week, well, that could be a bull trap forming right there, which obviously good for us who, well, those who are shorting like me or building into a short, like I am doing. Hopefully that does play out, and we can do good there. And the reason why I wanted the rally to continue rallying until it gets to that downsloping trend line is, if the market were to turn around right now, my short position would, maybe be 2/3 of what I wanted it to be. But if the market were to rally for a few more sessions and get up to that downsloping trend line, then I could build out a larger position. It would give me time to do so, because I don't want to, I never just jump right in, especially this year, with a full position size right out the gate. I always ease into it, small position size, and then slowly grow it as the market starts to get to these key levels. Okay. So right now, I'm not in a full position size to short the market. I'm in a small position size that today I added some to it when we got up there to that 400 level. I added more to it when we got to the 4,000 level on the SPX. I added more to that position. Now, if the market continues going, I can add more until we get to that trend line resistance. Now, you can do some short-term longs to protect your short position that you're building. That's fine to do to help hedge against that, just in case the market does happen to break and, FOMO gets in and it goes higher than that trend line resistance. I don't think it will, but it could. All right, let's go to the Qs here. All right. Okay, there we go. See, I think it's loading a little bit faster. That's good. All right, so let's put right now, if we go from here like this, all right, and we go here like so, yeah, you could potentially see a flagging pattern, and maybe tomorrow, maybe the Qs break out tomorrow and start heading towards the weekly expected move up near 291, because that's where the weekly expected move is, 291. Now, if I bring this chart down just a little bit, yeah, it is faster. This chart is faster now on this program. We've got that trend line resistance right here, down sloping, and the 50% retracement is just above the weekly expected move right here at 294. So if the Qs technology want to start rallying, in my book, that's good, because I can build into that short position. And then it gets up to that downsloping trend line, and then things can turn around, right? From there. Okay, because look at the picture of what's happening right now. Things just, I don't know. We're not in a bull market. The economy is getting worse. Look at all these companies. Every day I'm reading a news story after news story of people being laid off. So it's not looking good. It's not looking good for the economy. And if we get an earnings recession, which I can't see earnings growth, if it wasn't for energy, right, this year, if it wasn't for energy, you know, or I should say, if you take away energy, all right, earnings only grew 1%. 1%. Earnings grew by 1% this year. If you take out energy, you add energy and earnings growth were up. But you have to remove energy because we had a fluke spike with energy, mainly due to the Russia-Ukraine war. So, just keep that in mind. Earnings are going to come down. They're going to be revised lower, which isn't going to be good for 2023, especially Q1 and Q2 of 23. Okay. Now, that retail report that came out today, obviously that could have helped. That was definitely a catalyst today. All right, let's clean this up right here. So, depending on the news tomorrow, the Qs, this is where I would watch really for a breakout is at 288. There is a lot of stickiness right here. And if we look, so last Thursday or last Friday, I should say, which was the follow-through day of the big Thursday rally, we got to a high of 288. And then on Friday last week, we closed, or I should say we opened the day at 288, and then we dropped off and we closed at 284. So that 288, if we're really going to have a breakout tomorrow, it's going to have to push through 288. Otherwise, that could be a ceiling for tomorrow, 288. And we're at 285. That's where we closed today. So we're not that far off from it. So that's what I would be looking at. We have that same, you could say, flagging pattern here on the Qs. You can also look at it like this with resistance, and you could say support right there. Maybe get a symmetrical triangle out of that one. And, symmetrical triangles, they can break either way. They can go up, they can go down. Remember how in phase was positioned yesterday with a symmetrical triangle, ENPH for in phase. I just want to roll over there real quick. I want to show you because it did break out today. It was up 4%. So that was a nice catch right there. We were talking about this resistance up here. Oh, it wasn't a symmetrical triangle. It was an ascending triangle with a flat top. Rising support, flat resistance, but it did break through that resistance today. But I don't think it's got much left in it. I don't think it does. It closed at 320. This line up here at about 324 to 325, I think, is ultimate resistance. And there's a lot of companies out there who are getting close. A lot of stock charts out there who are getting really close to a stronger resistance zone, like in phases is getting pretty close to it. And that could present a problem and potentially what causes this market to pull back when we reach those downsloping trend lines that have caught every rally in 2022 and so forth. Okay, let's go to the IWM, which is your small caps. They put in about a 1% move today. SPY about a 1.35, Qs 1.44. The DIA, which is the Dow Jones, which has been outperforming, it put in 1.16%, but the IWM not quite as much. And why? Because it's at its downsloping trend line. Because remember, the IWM and the small caps, they ran hotter, faster than all the other main indices. So right now, and let me adjust this chart real quick, and look at that. Look how quick this thing adjusts now. This is great. Look at that. Look at this downtrend channel that it's been in. And it has stopped the two major run-ups, obviously where it started back in January, or actually in November is when this channel started. It stopped the mid-August, and now it seems to be putting up defense to stop the IWM from climbing any higher. So I don't think I'd put my eggs in the small cap basket right now, just because of that fact that it is up against that trend line resistance there. All right, let's open this up here a little bit so we can get a better view. I am not used to this chart moving this fast during a live stream. All right, let's pull this thing up. Nice. Okay, so yeah, we also have some the 200-day converging. Oops, what did I do? Hit the wrong button. We also have the 200-day moving average converging with the downsloping trend line. That's also another negative for the IWM. This thing, I just don't see it going much higher. I know it broke out. A couple wicks broke above this. It broke out and closed above it one day. But it's just finding a lot of resistance there right now. So I really don't think that, you know, this could be it for the IWM. This could be the line for them. But the SPX, the SPY, the Qs, they're just not there yet. I see your question. I don't want to ignore it, but how shorting puts? Okay. You can, if the stock market is going down, you don't have to lose money. You can make money when the stock market is going down. All right. And there's two ways to do that. You either buy in to an ETF, or they're technically called ETNs. To give you an example, if you wanted to do that on the SPX, it's SP. Oh, I've got to get my cursor back over here. Its ticker symbol is SPXS. And this is the direction daily S&P 500 bear, which means it tracks the S&P 500, but it's inverted. And it does it at a 3x. And then the other way is to use the options market and actually buy options contracts. I don't know if you're familiar with options or not. But I just wanted to at least give you these two examples here. Goodness gracious. Okay. Spam in the live chat. I wish I could figure out how to get rid of that. Okay, so going back to it, options are tricky. Options take time to learn. And you really got to dedicate your time and attention to learning options. But once you do, they're a great way to trade the market. Okay. But if you are still new to investing, then one of the ways to short the market, which is making money when the market goes down, right? Having a green day when the market is red is using these ETNs or ETFs because they trade just like them. You can buy one share of SPXS for $19.90. And if the S&P 500 goes down 1%, this will go up by 3%. Okay, so it's also leveraged, 3x leveraged. All right, so if the market were to crash 10%, you'd be up 30%. That's how these products work. Now, these products aren't designed for you to invest in these long term, because you're just going to end up in the same spot if you were to bought a normal ETF, because when the market is green and the S&P 500 goes up 1%, you just lost 3% if you were still in this vehicle. So it's a good vehicle to use to trade the market, okay? Which I do. I use these. There are a whole bunch. Direction is the company that puts these ETFs together, and I like their products. I use a lot of the Direction ETFs for shorting, going long. You can go SPXL to go long the S&P 500. So if you think the S&P 500 is going to move up, you hop in here, and it's leverage. Same thing. If the market goes up 1%, you go up 4%, which, I mean, you can see that right here. The market was up, let's see, 1.35%, and this was up bottom right-hand corner down here. This was up 4.04% on the day. So you can go both ways on these. So I like to track the SPX on the S&P 500 and then trade these or options or a combination. So if you're just starting out, though, these are a great product to test the waters on, because they are leveraged and they either move in the direction or they move in an inverse opposite direction. And they're a lot easier to understand than the options market. So if you want to get started, use these first while you're learning how options work, and then go into the options market. But while you're learning it, you can still use chart analysis and trade these products. So you've got those that you can use to your advantage. Okay, what else do we have here? All right, tomorrow at 2 p.m., we do get the FOMC minutes, okay? The minutes are going to say whether this market is hawkish or this market is bullish, okay? I'm sorry, hawkish or dovish. I lost track of my my thoughts there for a second. Plus, let me do this right here. Okay, so yes, reading the Fed minutes, it's either going to say, yep, hawkish Fed, you know, the terminal rate, how far they're going to take this is going to be much higher than 5%. Maybe they're going to 7%. Or this could read dovish. I don't think it will. I think it will read hawkish because that's what we've heard from the Fed. Hawkish statements, hawkish comments. Jerome Powell has been hawkish. So we do have that. That comes out at 2 o'clock Eastern. So that's in the afternoon. Tomorrow morning, One earnings report, real quick, though, I want to bring to your attention is John Deere, ticker symbol DE. Their earnings come out tomorrow. Now, peers of John Deere have already had earnings, and they were good. So with John Deere, I think it's possible they could have decent earnings, but the one thing I would be a little concerned about is a sell the news type of action. Because if we put this trend line here, okay, I mean, this thing has just been going higher, going higher, going higher. No stopping it. It's not near any highs, right? Let me back this up here. So, I mean, it can go higher, as you can see there. I mean, if earnings were spectacular tomorrow, better than just, hitting the nail on the head, if they really did something impressive. And I think the key is going to be their guidance and how they present, how they talk about next quarter. Maybe we could get a bounce that pushes Deere up to the $450 a share range, right? All the way up here. Maybe it does. This is a very strong resistance zone up here. And if we go back and look, the last time Deere was in this price range, all right, it's when we were dropping like a rock in the market, okay? And then prior to that drop like a rock in the market, we rallied, okay? So there's no real support and resistance for John Deere in its current price form, right? Where it's currently situated. If we look at the volume shelf profile, once we get above this level right here on the volume shelf profile, which lines up to right where John Deere's at right now, there's a vacuum. There is a gap here in the volume shelf profile. So if earnings are good and if guidance is also good, Deere could shoot right up through that gap and then start hitting resistance. And again, that's going to be up here in this red shaded area. Let's call it 435 to 450. All right, $15 spread there. If the earnings and guidance are good, it could get there. Otherwise, if it's just average and they bulk about next quarter, well, then we could see a sell the news for Deere at this level, and then it would just come on back down to support, probably around the 395, 393 area, right about where this blue box starts to pop up at the top there. You are welcome. Any question, I'm glad to answer it for sure. Absolutely. Okay, let's see here. Also tomorrow, I know it's not Friday, but we do get weekly initial claims tomorrow. The expectation is 226,000 jobs lost, and the expectation is 222,000. Continuing claims, the prior reading was 1.5 million number there. We also get the October durable orders. The expectation is 0.4%. Prior reading was also 0.4%. And durable orders ex transportation, they take transportation out of the numbers. The expectation is 0.1%. Remember, last time around, that dropped 0.5%. So pretty substantial drop there. And then, and those come out at 8:30 a.m. Eastern. Both of those do. And then at 9:45 a.m. Eastern time, this is all in Eastern time, we get the preliminary November IHS market manufacturing PMI. The prior reading was 50.4, and the preliminary November IHS market services PMI, and the prior reading was 47.8. Key to know, 50 is the contraction expansion line. All right. Last reading, 50.4 for manufacturing. That is still expansion or growth. Services, prior reading, 47.8. That is contraction. That is slowing down. All right. So manufacturing is really, really close to being in a contraction phase, just like services. And again, that's at 9:45. At 10 a.m. Eastern, we get the October new home sales. The expectation is 578,000. The prior reading was 603,000. And then final November University of Michigan Consumer Sentiment Survey. The expectation is 55.5. The prior reading was 54.7. So we'll see how that all shakes out tomorrow. And then, of course, don't forget the Fed's FOMC October meeting notes, all right, or their minutes. That'll be a big deal for tomorrow. Other than that, that is all of my notes. If you have questions, now's the perfect time to plug them in. We can go over them. Otherwise, we'll wrap it up. If you could do me a favor, though, real quick, and just click that like button, share this video with a friend, and join us. If you like the perspective, join us by clicking the first link in the description. You get access to weekly expected moves, weekly momentum stocks, numerous trade ideas, a whole bunch, private Discord, a whole kit and caboodle to help you along your investing and trading journey. It's just knowledge is key, and we provide some knowledge. So consider doing that as well. All right. Any questions? I know I take your questions as we roll with this live stream, and I greatly appreciate it. But I definitely want to dedicate a portion of time here at the end for your questions as well. So I'll give you a minute if you have any. Otherwise, we'll wrap it up. I'll be back tomorrow after the market has closed to talk about what happened, why it happened, and what to expect going forward. And remember, the market is closed all day on Thursday, and the market does close early on Friday. It closes at 1 p.m. Eastern. So there's not a lot of volume tomorrow. You're going to see it drop off, and not a lot of volume on Friday. And quite frankly, we may not get a true reaction until the big wigs are all back in at their desks in Wall Street or on Wall Street on Monday. I lost the train of thought for days of the week. Where would the market be without energy? That's a good one. You know, I don't know where it would be. It'd be a lot lower. I don't know where it would be. If you take out energy, I mean, earnings growth were only 1%. Earnings growth were only 1%. That data comes from FactSet, so you can fact check it. It comes from FactSet, 1% growth for earnings. That's not a lot. And again, that's taking out energy. Let me pull up oil here because it did just right quick here. First, the dollar did pull back today. Remember yesterday, it did jolt, it did pop, it did move higher. Today it pulled back a little bit. Let me open this up here a little bit. I definitely love how much quicker this screen moves here. You know, even though the dollar, it pulled up, it popped yesterday, and it came back down today, it's still right there within its weekly expected move, nearly right in the middle of its expected move. So for the dollar, as long as it stays up above that 105 area, it's good. And don't forget too, with the dollar right now at the lower end of the weekly expected move, the 200-day moving average is sitting right at the bottom end of the weekly expected move. So if the dollar does drop some more, it may still remain in there within that weekly expected move and above 105. I think that's like the last straw. 105, maybe as low as 104, but if it breaks below that, I think the dollar's run is over for sure. Okay, let's see here. I want to make sure I get these up. It's still kind of weird using the new Livestream software today. Can energy also lead to downfall? It could. The problem, though, is think of it like this, okay? When you look at the mega caps that are out there, FANG stocks at the start of this year were in mega cap territory, all of them. Take a company like Exxon or maybe Shell, or Chevron, I mean. They weren't big market cap companies like Facebook, like the FANG stocks were at the beginning of this year. But what happened this year, Exxon market cap grew, Chevron's market cap grew, but Meta's market cap shrank. They swapped, okay? They swapped places. So as long as something, if energy does go back down and they lose the big mega cap, status, as long as something comes back up to replace it, then I don't know that energy would pull the market down. It is a heavy weight in the S&P, but it's not the heaviest weighted, okay? Now, if something did not come back up to replace their market cap, then sure, energy could lead the market down. But that's not typically how energy works, right? Energy affects inflation more than anything else. That's what it affects, because everything is derived somehow of energy, right? You just think of transportation. Everything is transported across the US to get one thing made here over there to the person who wants to buy it, right? Things are constantly shipped. All of that money wrapped up in transportation is wrapped up in energy. So that's why it's more of an inflation driver than a market driver in that sense, okay? Because there are heavier weighted, like technology, big time heavyweight, all right? So as you can see with this year, even though energy came up and energy performed well this year, because technology got hit so hard, the market fell. The market did not stay in a bull market run. And we got into a bear market because technology fell and energy is not as heavily weighted as technology. So no, I don't think energy could lead us down further, with the caveat of energy is an inflationary driver. Okay. So if it comes down, inflation comes down. If it goes up, inflation goes up. Let's see. Or is it expected to do good next year too? Well, I don't know or have an expectation on what oil is going to do next year, but I have to imagine that something's going to happen. And it kind of goes to the BRICS monetary system. If it's pegged on commodities, and oil is one of the commodities that it would be pegged to, if their currency is pegged to oil, then they're going to want to keep the price of oil elevated. The U.S., and I think this is why Saudi Arabia kind of snubbed the U.S. and is looking to China for the next 50 years with oil and selling oil and wanting to join the BRICS nations. The U.S. is rapidly trying to turn into the EV capital of the world. So with this aggressive push to electric vehicles, Saudi Arabia is like, hey, ICE vehicles, internal combustion engine, those vehicles need us. And if you're not going to have those vehicles on your American highways, then we're not going to have anything to do with you. China is still going to have them. So we're going to focus on China. And they're going to be our partner in the future. And you're not going to. So it's an interesting thought experiment on what's going to happen next year. Because as EVs get pushed, maybe the supply that we need for oil, if we get big EV adoption, then maybe the price of oil falls due to demand. The demand question about China continues to go up and down and up and down and up and down, and oil is just kind of bouncing along with that narrative of whether China is going to reopen and need more oil, or if China is going to remain locked down and need less oil. Just think about the U.S. If the U.S. is stepping out and not needing as much oil due to electric vehicles, what's that going to do to the market? So that's interesting. Okay, let's see here. I like that last question. Is there a way to hedge a portfolio that is heavy weighted in energy stocks? That's a good question. Energy is about the third weighted. Let's bring up the business cycle here. So when we are like peak stock market, that's typically right here. You can see energy is right in the middle of that peak. But this year's been a little bit different because as the stock market has been dropping, and now in the latter half of the year, now that the business cycle is also dropping, if we look at energy companies have been going up. And let's just use right here ExxonMobil, who's been one of the best stocks of the last couple of months. It's been phenomenal. It's been like in our our number one momentum stock several weeks in a row. It's still on the list this week, not in the top spot, but it is on the list this week. It's just been doing good, but it is at a bit of resistance right now. And we can draw the line right here. But the reason I wanted to show the market cycle is technology and discretionary are where your bigger weights are over energy. So if you want to protect a portfolio that's heavy in energy, look to technology, look to discretionary. Okay. XLY is discretionary and XLK is technology. You'd want to look towards those two sectors, find companies within those sectors to balance your energy. Okay. And the good thing is that as we move into Q1 and Q2 of next year, with the market, finding a bottom, all right, the market finds its bottom right there. Didn't mean to draw over it. The market is in a full recession. Business cycle is going down, but the market has found its bottom. It is starting to go up. That's when technology and discretionary take over. So Q1, Q2 of next year, really start looking for technology, consumer discretionary. Again, XLK for technology, XLY for discretionary. They should be the ones outperforming, okay? And if we're not just looking at the stock market, if we are looking at everything, TLT, which is bonds, this is your 20 plus treasury bond ETF. TLT should start outperforming the SPY as we go from the end of the business cycle to the beginning of the business cycle. I thought I had my cursor over here. There we go. TLT. All right. So looking at TLT, it has just been crushed since the mid-August top there. It kind of made a double bottom here, and it has been rallying now, but it is at a bit of resistance right here, and that cuts in right here. And TLT bonds, they should start performing well once we get to, on this market cycle, once we start getting over here, okay? This is where bonds start to do good, all right? And they will outperform the S&P 500. And it's typically right about here on the business cycle when it's starting to tap that bottom. It's starting to locate where that bottom might be. That's when TLT will start to really open up the throttle. That's another one to look to for offsetting energy. So I hope that does help. Let's see here. The major rating services indicate that the majority of the energy shares are undervalued, unlike other companies. This seems to a market that favors value-oriented stocks. Well, if we look at the growth versus value, value has been outperforming growth over the past couple of weeks. Now, prior to the past couple of weeks, growth was outperforming value. And we talked about that exact thing yesterday. In this period of time that we are at, value tends to do pretty well because investors who are just completely fed up with the market, they want to find a good company who can weather a recession and their value will not go down much further than it is now. That makes a good value play right now because they don't want to be in cash because inflation eats that away, because you're not going to make in a high yield savings account the same return as inflation right now, or a better return than inflation right now. So your dollars are getting eaten away. But if that money is stored away to buy stocks and stocks continue to go down, well, then you can make the argument that maybe the cash that you're holding isn't being eaten away, but stocks would have to go down at least the same amount as the inflation rate to kind of break even on that. So let's see here. I think I just lost my train of thought. What was the value oriented? Yeah. Okay, so good observation there. Value has been performing well, and value should perform well until we find our bottom. Once the bottom is set, and once we start to rally past key resistance areas that have held this market down, like, for example, on the SPX, let me load that real quick. And let me adjust the chart. The major downsloping trend line of 2022, that red trend line there, that has been, boom, right there, caught that high, boom, right there, caught that high, boom, that high, and slide it over a little bit, boom, is it going to catch the next high, right? And then we go down from there. That's not finding the bottom. That's being rejected, and that's making lower highs. We are also been making lower lows. Low, lower low. A couple of lower lows. Another couple lower lows. A lower low right there. But that lower low, it could have been lower because that trend line right here, it didn't make it to that. All right. So what we would need to see is higher lows and higher highs. Once that starts, then people will start buying growth stocks hand over fist, because you'll see they've been beaten down the most. They'll get the biggest jolt. Okay. So keep that in the back of your mind too. Okay, let's see here. Is there any way to see where we might be in the business cycle? Unfortunately, not that I'm aware of, but there are several charts out there like this, and there are some that are a little bit more detailed than this that are out there. And you're basically looking at, well, what typically does well, or the question to ask yourself is, what's doing well right now, all right, versus what does well at this time in the business cycle, okay? And that's how you figure out where we are. And it's not too complicated. So what's happening, what's working right now, what's strong right now, and where do those things play a role in the business cycle? And that should give you an indication of where we are. There's basically 6 main stages of the business cycle. We are somewhere right now either in late stage 6 or early stage 1. Okay, that's where I think we are in the business cycle, somewhere in between there, which means we're about to see a shift in what's been working, which will be a rotation out of what's been working into what is going to be working next. And that'll shake up the markets a little bit too. So just do a Google search on business cycle, and there's a lot of different material out there. Read over a few of the charts, and you'll get the hang of it. If you happen to find a place that does exactly that, tell you where we are exactly in the business cycle using some algorithm or science, I'd be curious to know what that is for sure. And then it looks like the last question here, and then we will wrap it up. How can we find value stocks? Well, you can do a whole bunch of, you can use a whole bunch of different screeners to do that. TradingView right here does have a stock screener, bottom right corner. Let's see. You can tap on that and it will pull up its stock screener. I can make it a wee bit bigger here. But there's a lot of different things you can search for, a lot of criteria, different things you can change to go through that stock screener. So use a stock screener, and you can find value stocks. You can find dividend stocks. You can find nearly anything that you want. Let's see, I haven't used the screener typically down here except for trend spotting. Another site outside of TradingView is finviz.com. That's another stock screening service, one of the best ones, quite frankly. TradingView is good for certain things, but you can search for what any characteristic you want in a stock on FinViz. It is pretty incredible, so you just open up their stock screener, and or you can use the pre-programmable ones down here and search for anything that you want. The top right here, it says screener. You click on that and you can just start entering in what you're looking for. And they have got you can even use chart patterns like on TradingView to find that. And find value, dividend, volume, cap. It just goes on and on and on and on. Float. I mean, there's just so many different criterias that you can search for. Finviz.com is probably the best place to find value stocks right now. I don't think there is a much better place. Okay. All right, cool. All right, so let me put this back down. Okay, Anya, you are welcome. Absolutely. Yeah. Oh, I didn't miss that. I think Biden is killing SoFi. Unfortunately, SoFi. My cursor right. SoFi. Yeah, it's been hurt for sure. This whole back and forth with the college forgiveness. But I do believe, didn't SoFi hit a 52-week low today? 490. I'm sorry, 460. Yep, it did hit a 52-week low today. I thought it did. That's fine to me. That's fine. I am happy. I just don't want SoFi to become a penny stock. That's something I wouldn't like. So I hope it does find a base in opening this up. And again, I love how fast this chart moves and how clear this chart seems to be on the screen. At least for a little bit there. I know SoFi, look at this. I mean, 1, 2, 3, 4, 5 days in a row of, well, I guess there is a small little green candle halfway in between there. But 5 out of 6 days right here, down 4.7. What's that next one? 4.7 also? No, not 4.7. 4.7, 5.8, or 5.9, 3.7 down, 2.7 down, 5 percentage points down, a tenth of a percent down. So down 1.5. Oh wow! So 1, 2, 3, 4, 5, 6, 7 days in a row, SoFi's been down. All because of what Joe Biden's doing with the loan forgiveness program and the court battle that he's going through. So, yeah, I just don't want it to become a penny stock. If it could, hopefully, find a base. The stock can be volatile, obviously. You get the Wall Street bets in here. They're constantly moving this stock on news. So it is has some pretty big swings. So keep that in your mind there. But the 52-week low today, 460, up a little bit from off that low by 4 cents. Okay. Yeah, that's BS. They said, oh, let me put it on the screen. I keep forgetting to do that. That's BS. They said it would be like the last time, like 3 times ago. Yeah. Who knows? It's politics. It's politics, unfortunately. And that's the name of the game in politics. Okay. Well, is everyone wrapped up? Everyone good? Button up tight, ready for tomorrow? We've got some data coming out tomorrow. And we are at interesting places. IWM thinks is at its long-term resistance for now. The SPX, the SPY, yep, ready for tomorrow. Awesome. Well, then I'll sign it off for here. Remember to click the like button, share this video with a friend. Those are very helpful. It will be helpful to get a clear direction soon. Yes, it will. For many different things indeed. Once we get through December, maybe we'll have some clarity on the Fed, like maybe one more rate hike after that at the the February 1st meeting, FOMC meeting. And then maybe the Fed will say, yeah, we'll hold that there until the data tells us that we can start to drop the Fed funds rate. So hopefully more clarity on many fronts are quickly approaching. That would help the market. Clarity, the market loves. Predictability, the market loves. Calmness in the world the market loves. So awesome. Well, I'll wrap it up here. I'll be back tomorrow after the market closes to talk about what happened, why it happened, and what to expect going forward. I do greatly appreciate each and every one of you for joining me. Your time is precious, and I'm glad you spend it here with me every evening. The market is open. I love your questions, so catch me again tomorrow. We can talk about it. Or if you are heading out for Thanksgiving or wherever you're going for this little break we're going to get to have on Thursday, enjoy it if I don't see you tomorrow for some reason. So with that said, I'll wrap it up from here. I got to figure out where to click the end button. I think it is here, and I got it. We're good. Okay. Have a wonderful evening, and I will see you in the next video. Take care.